Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. While individual investors remain committed to stocks, institutional investors change their behaviors based on the quarter's end. Joining us to discuss is Steve Sosnick, chief strategist at Interactive Brokers. And Steve, it really was an incredible ride in the markets for the first quarter. And just to see how the behavior changed in the last couple of weeks was also something interesting.
It was wild, Jill. I mean, think about, one of the things that I pointed out yesterday was, think about what this market has endured. Think about what we as investors have endured over the past 3 months. Fed rate hikes, geopolitical tensions, inflation, and yet most major indices were down single digits. That's really a pretty good result. But a lot of the benefit, well, I'm not going to say a lot of the outperformance or move to underperformance, I should say, really came in the last couple of weeks. And I do really think institutional investors changed their strategy dramatically. I think they were raising cash, selling stocks and bonds for cash. But then I think as markets rebounded a little bit after the Fed meeting, they decided to employ the excess cash that was on the books, put that into stocks. They continued to sell bonds, and I think they put some of that money into stocks. And that's why we saw it rally. But that's also, I think, why we saw the rally abruptly end Tuesday afternoon, because that was the last time that institutional investors could buy stocks for delivery at the end of the quarter, March 31st. And so that was, I think there was a fair amount of window dressing that was going on, which remains to be seen whether that's the case. As of today, it doesn't disprove that theory.
And Steve, have you seen any volatility assumptions change since we spoke last?
Surprisingly not. I think that we've in our last discussion, we talked about how the volatility assumptions flipped from quite nervous to relatively normal. Most volatility measures back sort of closer to long-term ranges, closer to, with term structures that are considered normal as opposed to inverted. That's all relatively calm. We haven't seen that change over the last couple of days. I think that's a pretty good sign. I don't think we got to truly complacent levels. I'd have been a bit more nervous about that. We only really flirted with complacent levels for a day or two, but we haven't really gotten much more nervous even as we've sold off since. When I say sold off since, meaning Wednesday, Thursday, and today. So yeah, I think I don't want to give it the all clear, but as of now, we're not getting a strong message from the volatility markets about further nervousness or complacency.
Right. And I know you're always paying attention to VXN and Vol Q. Anything that you see there, or is that still suggesting stability?
That one is remarkably stable. I've discussed several times before with you how I like to look at VXN minus VOLQ, because we can subtract out the impact of the wings, as it were, the out of the money puts and calls that influence VXN, not VOLQ. And that relationship has been incredibly stable. Just above, just with a spread just above 3. What that tells me is investors really haven't gotten a big sea change in terms of their risk parameters, whether it's to be more risk aggressive about taking risk on out of the money options, or on the out of the money call side, or hedging risks below the market. I think there's the amount of stability that we've kind of wandered back into is really quite amazing, considering where we came from just a few weeks ago.
And Steve, I know you're also getting a lot of questions around stock splits. Tesla, of course, which was just announced the second time in just 2 years. GME was also talking about that as well. What are you hearing from investors? What are they asking for?
There's 2 questions that get asked. Does the stock split mean anything for the ordinary investor? My comment there is it's marginal. It's, what you're doing is you're making change, for the same reason that sometimes you have a $20 bill in your wallet and you want 4 5s or 20 singles. It makes it marginally more, there's times where has marginally more utility to you. But it, in this era of fractional shares, it doesn't really mean that much in terms of affordability. Where it does mean something is for option holders, actually, because if we're talking about contracts where there's 100 shares per contract, where each contract represents 100 shares of stock, they become markedly cheaper based on the amount of the stock split. In the case of Alphabet and Amazon, which are splitting 20 to 1, that's a huge increase in affordability for option traders. In the case of Tesla and GME, where the plans are a bit more nebulous, shall we say, less set in stone, and even so, looking at less aggressive ratios, that impact is going to be more modest, although these are stocks that are often driven by option traders. And so that could have a positive benefit when the sentiment dictates.
All right, Steve, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.